the blockchain experience. Bringing dope content to the audience. Welcome to the blockchain experience. Bringing dope content to the audience. It's the blockchain spell. Maynard David's got so much to tell.
Hello, GM, and welcome to another episode of the Blockchain Experience. I'm your host, Meta David. Although we're in February now, I think I can still say Happy New Year, so Happy New Year. Hope everyone's 2024 is off to a great start. It's great to be back after a winter break there. So we're kicking off the season with a banger. Our conversation today is with Sanjay Raghavan, VP of Web3 Initiatives at Roofstock, an online marketplace for investing in leased single-family rental homes. This was one of my favorite conversations because we talked a lot about use cases of the blockchain outside of the traditional NFT and DeFi stuff that people generally participated in this space. Although I would say those things are very much intertwined with what Roofstock does. And we also talked a lot about real-world assets outside of real estate. So Roofstock is a traditional real estate company like I described, but they rolled out a Web3 component where you could actually buy a house beginning to end in less than 30 minutes, which Sanjay talks about in our interview. Really impressive stuff. So I really enjoyed this conversation. I hope you guys as listeners do too. So we'll get to that. And then after that, I'll give you guys an update on Scoop 3, which is a next generation Web3 podcast player that we've been building over here at Media 3 Labs. So with that, we'll get to our conversation with Sanjay from Roofstock. Sanjay from Roofstock, how are you doing today?
I'm great, David. Thanks for having me. It's a pleasure.
Yeah, the pleasures are. So I'm happy to have you on because Roofstock is, I feel like, really at the intersection of real estate and blockchain, and you guys are really applying blockchain technology in a very thoughtful way. And that's something I've talked a lot about on the podcast, hence the name, the Blockchain Experience. We haven't had someone represent kind of like the real estate space. And to me, that's one of the most obvious use cases of blockchain technology. So we'll talk about that in just a little bit, but why don't you just kick it off with an introduction of like yourself and a little bit about maybe Roofstock for our listeners that might not be familiar and what you do there.
Sure. My name is Sanjay Raghavan. I'm VP of Web3 Initiatives at Roofstock and also working on a few other strategic initiatives. We're looking to launch some funds, so I'm helping out with that. My background, 25 plus years in mostly in financial services, but in product operations, finance, and several years in investment banking as well. So I come from that TradFi mindset, and I've been always trying to, having worked in TradFi and knowing what problems it presents, especially when it comes to how small and medium enterprises are cash starved. The large banks are not necessarily funding them. They have to look for private sources for capital. I've always felt that the capital markets are only efficient if you're a very large corporation. And if you're like a small and medium enterprise, then the capital markets are actually extremely inefficient, in the US and probably in the rest of the world as well. And so, when I came across blockchain and DeFi and all the things surrounding real world assets or RWA, it was fascinating for me to see that there was a different way of approaching the same problem and really trying to connect demand and supply in a way that's not been done before, using this sort of technology infrastructure of Web3 solutions. And so I started getting more and more into it. Obviously, at Roofstock, I was tasked to going and finding a way to sell and settle rental properties using this using Web3 technologies, just to, as a proof of concept to see what is possible using technology. And we took on the additional challenge of seeing how can we also add leverage to it. So we, bring the entire real estate experience, but try to do it on the blockchain. And we did successfully complete that proof of concept. We sold a few properties to demonstrate that it can be done. And then in addition to that, I also advise RWA companies and other DeFi lending protocols And on the fund side, I'm also an advisor for Pudgy Penguins. So, try to stay abreast of what's happening in the space, mostly with respect to real world assets and tokenization, but also, other fund projects. So Roofstock itself, we've been around since 2015, really specializing in the single family rental sector, which in the US, there's, when you think about rental properties, you're generally thinking about big multifamily units, but there's about 21 or so million single family residences that people use as rentals. And so it's one of the largest investable asset classes, mostly owned by retail mom and pop investors who, have a few doors, right? Less than 10 doors that they've accumulated over time. And they're using the rental income as fixed income supplement, for retirement and stuff. But again, it's 21 million units, $4 to $5 trillion in total asset value. So it's a fairly large asset class. And, we as a company looked at the problem and said, traditionally, people tend to buy investment properties very near to where they live because it's really hard to buy these assets sight unseen and manage them remotely. And so Roofstock as a company started with the principles that we need to make it easier for people to be able to access this asset class and be able to buy them remotely. And what we did with Web3 was take that a step further to say, well, it's not enough to just identify an asset and be able to underwrite it remotely on your computer. But when you want to buy it, you shouldn't have to, go through 3 or 4 weeks of stressful closing process where you're, ordering inspections and appraisals, and you're trying to find more information about the subject property, and things come up in those inspections, and then you're going to, you're trying to renegotiate the offer. Sometimes it works, sometimes it doesn't. It's stressful both for the buyer and the seller, this process, closing process. So we wanted to see, can we make it an Amazon-like experience where you spend all your time diligencing what you want to buy? You may go through on Amazon, you might go through customer reviews, you might look at the product features, videos, and whatever else. But when you've made your decision to buy it, you're not expecting that somebody's going to load that product into a container in China and wait for it to arrive in Los Angeles 4 weeks later and then get shipped on a truck to a warehouse. And, like 8 weeks later, you have this little trinket you ordered on Amazon. You want that, next day, same day, next day through Prime. And so we wanted to see, can we really replicate that Amazon experience for real estate? And that's, it was a tall order, and it involved a lot of legal engineering. I'd say a lot more legal engineering than really technology engineering, but eventually we were able to get it done.
So that's really interesting. How long is that sales cycle? Is it literally like a day or two from all right, I found the home, I want to buy it, a day later, maybe 2 days later, it's mine? Or how does that look like?
So if the property is already tokenized and available for sale, the end-to-end process is like half hour, really. After you've not diligenced and decided you want to buy it, we do, for compliance reasons, need to make sure that the buyer is KYC'd and allow listed to purchase the asset. Because again, you're buying US real estate, it's going to be income producing. You cannot use these assets for money laundering or terrorism or any other illegal activity. So you do have to go through a KYC process. But that's all fairly automated, and the KYC process takes a couple of minutes. If you and these sales happen on stablecoins, so assuming you have stablecoins in your wallet, and again, if you were doing it as an all cash purchase, it's literally the amount of time it takes you to go to once you've been KYC'd, which is a couple of minutes, to go to OpenSea or whichever NFT marketplace, connect your wallet and make the purchase. If you have leverage, if you're going to use leverage to buy the asset, then there's the additional step of working with the DeFi lender to, so you perhaps send your down payment to a smart contract. They send the rest of the money, and then the smart contract goes and makes the purchase, right? So that end to end with leverage, it's taken us about half hour to complete the sale.
I kind of laugh because I feel like with a purchase, the process in the traditional world is more like minimum 30 days, 45 days. But you're talking about literally minutes. And some of that has to do with the KYC portion of it. So yeah, that's super interesting.
Exactly.
And you mentioned earlier that part of the mission is to be able to purchase homes that are not necessarily local, which is kind of like a trend that I've observed also. So do you guys provide additional services on top of that to like manage the property and other things to kind of help facilitate that process?
Fortunately, because Roofstock, has been in the industry for several years, and we've facilitated so many transactions across probably 70 different markets. We have a very strong network of local participants that can provide a variety of these functions, right? So, we can give you a list of property managers that we have worked with in the past, and you can, as the buyer, talk to them individually and figure out which one best fits your investment objective and what you're looking for, and then hire that property manager. So we don't get involved in managing the asset itself, but we'll connect you with all the right folks in the local market so you can make those decisions.
You guys play in like the real world asset space, meaning this is all like tangible stuff, which is a little bit different than like in a way, you guys, it's NFTs, right? I mean, they're the houses are token. Maybe not the way that people know of NFTs, but it kind of is a non-fungible token, right?
Yeah. So the best way to analogize that, right, is to think of whether it's a fungible token or non-fungible token. Any form of tokenization is really the applying a digital wrapper to some asset, right? Now, other than digitally native assets like when people talk about NFTs, you're probably the first thing that comes to your mind is Bored Apes or CryptoPunks and so on. Those are digitally native assets where the actual value of the asset is that JPEG, right? And that's stored in some decentralized file storage system. In most of the other, especially as you're looking at real world examples, the asset that has the tangible value is something else. And what you're trying to do is create a legal representation of that in one way or the other using these digital wrappers. Now, in our case, the way that works is the property itself gets acquired into a single purpose limited liability company. And the operating agreement of that LLC says that the ownership of this LLC is determined on the Ethereum blockchain based on the wallet that has this particular NFT. So what you're doing is you're creating that connection between something that's off-chain, a real-world asset, and then something that's residing on-chain on the Ethereum blockchain, right? And you're specifically making that connection in the legal document of the limited liability company, the operating agreement, to say that this is how we will ownership changes to this LLC occurs is based on the transfer of this NFT from one wallet to the other. And so by having that part of the legal framework, essentially what that NFT represents is an association with the ownership of the LLC. And so there's really a legal meaning to this NFT in this case. It's not that the NFT itself is, worth $200,000 because it's not the pretty picture of the house that's worth $200,000. It's what that represents, from a legal point of view, right? And so in our case, the digital wrapper simply happens to be that connection with the ownership of the LLC. In other cases, you might have heard recently companies doing short-term loans on luxury watches. And these are done through NFTs as well. And here really, these watches are shipped to a warehouse and you get what's known as a warehouse receipt. That's your claim to that watch that's in the warehouse. And if you're able to create an NFT that represents a digital wrapper of that warehouse receipt, now you again, brought part of that workflow into the blockchain to say that people can now lend or borrow against this watch, and you don't have to, take that piece of paper and ship it around. You can now do it using this NFT, which essentially represents a claim to the warehouse receipt, right? So a lot of these real world examples are going to be looking at legal connections between what exists off chain and how can you, bring that legal connotation to something that's on chain, a digital wrapper that's on chain.
So how do you see the evolution of these real world assets, these RWAs, applications that you foresee happening? So you talked about real estate, luxury watches. What are some of the things that you anticipate will be happening over like 2024 and over the
the
near future?
That's a really good question, right? And I think if you take a step back and think 20 years back when the internet was first coming out, and Amazon and others were talking about this notion of e-commerce, you're like, how's that even possible, right? Because we were used to actually taking our credit cards to a store and somebody would flip the back of the card to see if your signature matched the signature on your driver's license or something. And so from that world, we went to doing electronic card payments. And there was a little bit of a transition to get there. And certainly in 1995, you could not have imagined this to be possible. But then like everything is happening through e-commerce today, right? Practically everything. So similarly, it is my belief that with Web3, you can fundamentally revolutionize how payments will work. And the stable coins are the fundamental infrastructure that's going to make that happen. Now, the challenge that we've had in Web3 so far is on-ramp and off-ramp. Well, there's two challenges, right? One is wallet abstraction. There's so many different blockchains. They don't interact with each other. They've all got their own little niche use cases, but since they all don't talk to each other, it's really hard. So wallet abstraction is something that'll have to happen over time. And also, just like you have, your Apple, your iPhone wallet, and that has the credit cards, and you just like bring your phone near the reader and it all just seems to work. You don't care about how your credit card is stored on the iPhone and how that's actually talking to the reader. We're going to get to a place where all that gets abstracted away, right? And then you just use your phone and you're able to make purchases. So that abstraction is required. The second thing that's needed is gas abstraction. You cannot have small microtransactions for $30 or $50 and end up with $8 of gas, right? Now, there are a lot of blockchains where the gas problem has been solved, layer 2s especially. But we need to see all these evolving a little bit more. And then finally, the question of on-ramp, off-ramp, right? If you're doing large transactions, like if it's actually, in fact, borrowing against a Rolex watch, that's, so you're taking out $50,000 loans, and you cannot spend 0.5% off-ramping that to fiat and then another 0.5% on-ramping it back to repay the loan. So we have to see that problem getting solved as well. So these are all different pieces of the overall infrastructure puzzle that people are working on, different people are working on. But once these get solved, stablecoins could very easily become suitable replacement, not maybe entirely a replacement, but at least a supplement. And in some use cases, you should be able to use stable coins for transactions and not necessarily always have to use a credit card, right? So it's possible we can get there. But these are small infrastructure pieces need to be solved along the way. So I'm really hoping that more people continue to work on solving these portions. Obviously, the two big stablecoin issuers in the US, Circle and Paxos. Circle's already a multi-chain stablecoin, and Paxos just announced their support on Solana. So they're also becoming multi-chain. Paxos is regulated by the NYDFS, and there's already legislation with bipartisan support for stablecoin regulation. So, on the one hand, I think the regulations need to catch up. And then on the other hand, these small infrastructure pieces need to be solved. But once that happens, you can presumably look at a world where, it becomes a lot easier to transact with stablecoins. And perhaps there's a mechanism for loyalty rewards or other things that can be shared as well, right? Because today the stablecoin issuers, issue stablecoins to you, and they take that money, they invest it in overnight repos or US treasuries, and they're making a 5% return on it. I think it'll get commoditized over time where they're not, maybe they're making 50 basis points, not 5%, but then the volume of stable coins is 100-fold what it is today. So these companies can still make good money, and then the underlying asset itself becomes much more available for transactions, and somehow the rewards are getting shared by the users and both the consumers and the suppliers.
So do you think there's going to be a world, because people are oftentimes, I feel like, currently very fanatical about like the blockchain that's being used. So from what I'm gathering, your thesis is more that the blockchain itself won't be overly relevant. That's going to be stuff that's going to be happening over the under the hood.
Yeah, I that's the direction I think things will go, because we used to have I forget now, but there were two different standards for cell phones back in the day, GSM and something else, and
CDMA,
CDMA, yeah, right. And then but you just it's not like with your number you could only dial the people on your network. You could dial any phone through your cell phone. So it has to get to that level of interoperability, and it is starting to get there, I think, right? Like I think Circle announced through its protocol that they'll be able to natively take USDC on one blockchain and issue on another blockchain. So it'll get to a place where it shouldn't matter that you're holding your USDC on Polygon or you're holding it on Celo. It really shouldn't matter. You should be able to just use it where it's with whichever e-commerce or any other vendor that's accepting stablecoins, right? And the same will happen with Paxos is now on two blockchains. They will also become a multi-chain solution.
Yeah, 100% agree. And that's something I've talked a lot about on the podcast before, is that I think in the future, it is going to head to that direction, and it's going to be a multi-chain future. We've seen this trend so many times over again, like you said, with cell phones, and going back before that, the internet, how you connect it to the internet, and if it's got like PPP and how just like stuff that today we don't really care. Nobody cares about how you're connected. It's just so long as you're on, you're on. And I feel like that's going to be the future as well, that all this stuff is going to be relatively ubiquitous, and you don't really care how you kind of get there, so long as it works the same way that like a light switch works. So having said that, do you think that we're going to have a future where virtually like everything's enclosed within that digital wrapper that you talked about, whether it's like groceries and other, like what are your thoughts around that?
Well, I think there's a lot of assets can be digitally wrapped. Obviously, with real estate, we took one of the most complex type of asset classes to do this with, because that's, our company is a real estate company. But I would presume that this evolution will happen with easier assets first, right? And the obviously the easiest asset is the US dollar. And that, with stable coins, in a way, you can think of stable coins also as in a sense, a real world asset, because it's wrapping a US dollar. And from there, I think you see that the evolution, people were doing private lending using DeFi for a long time. And the TVL was, again, if you leave out the portion of the TVL, which was using crypto to lend to crypto hedge funds, right, which happened during the DeFi summer and all that. If you leave out all of that and just look at real, lending to brick and mortar companies, that TVL was stagnating for quite a bit. And then, on came this kind of tokenized US treasuries. And from nothing, it's now at $800 something million in TVL right now. $800 million doesn't sound like a lot of money when you think about global capital markets. But, in just a few short months, there were like a dozen players who are all offering tokenized US government treasury securities. And, whether they were trying to do it as a regulated entity, in partnership with a regulated entity, there's so many different flavors of it. Some are open to US investors, some are not open to US, some are, right? But immediately a dozen people came into that market because they saw an opportunity. And so again, when you look at what are the easiest types of things to tokenize, nothing gets easier than US Treasury ETF, right? But from there, you can presumably see that other forms of debt, right? Why shouldn't munis, corporate debt, sovereign debt get tokenized? And in fact, Standard Chartered Bank has a company that they founded and spun off, and forget the name now, but a good friend of mine works there, and they've been looking at sovereign debt tokenization. And they just, I think, recently announced one. So you can start seeing how different forms of debt instruments can easily get tokenized. Again, if you're doing ETFs, all the ETF, once you've done one ETF, any other ETF, you could use the same model. So same could be done of US equities, right? So again, what you're seeing is that the public market securities, which are highly liquid, those have a faster, better traction at getting tokenized first. As you start progressing through that ecosystem and you start looking at more complex assets, right? Like taking we took individual houses and created a structure with those. But if you take a large office building and try to tokenize that and sell it in little pieces, a lot of people are experimenting with tokenization of these large, multi-$100 million buildings, but they're not getting, you won't see a lot of transactions happening on the blockchain right now. And that's because, those are fairly complex asset classes. They're all securities under US law, and you have to comply with all the securities regulations. It's not like somebody can just connect their wallet to buy a share of a large building in Manhattan, right? So those types of more complex asset classes, securities, private securities, that's going to obviously take more time. But in this sort of when you look at the entire spectrum, start with the public equities and public securities. Those are the easier ones to tackle. And then you're starting to see these really niche use cases like, this watch lending we were talking about earlier. Pawn shops, they're a huge market in the US. There's, from what I understand, at least $500 million of luxury watches get pawned every year, for short-term loans. If not more. So, again, these are not massive markets, but they're big enough where, a few players will be able to come in and make it more transparent, make it easier, faster, more standardized to, get loans on these types of assets, right? Short-term loans. When you think about private debt, right? Generally speaking, private debt itself is about $1 trillion in the US, probably, close to double that globally. But again, private debt has historically only worked for very large corporations. These may be companies that are not yet big enough to go public and raise public debt, but they're still, large enough where they're borrowing $50 million, $100 million, substantial amounts of money. There's certainly again, when you go back to that mom and pop shop, the small and medium business, if you want to get a $1 million loan today in the US, it's extremely hard. You're going to private money lenders. You're probably, in addition to providing them all kinds of collateral, you're probably providing personal guarantees. There's a lot of steps you have to go through to be able to raise $1 million, right? So in many ways, it's a lot harder to get $1 million than it is to get $100 million. And so that problem can absolutely be solved by bringing the demand and supply together. Of course, you have to have good underwriting. You still have to, just because it's on the blockchain doesn't mean you don't have to underwrite the borrower. But there are good borrowers out there with decent credit quality, but they're private, and the type of money they need is more illiquid than public securities, and for that they're willing to give you a premium, right? So if speculative public bonds are selling at a 9% yield, you can get on a unit tranche or a single tranche private debt, you can probably get 12-13% on that today, and that premium is what you're getting for the illiquidity. And once you start looking at other types of more esoteric, again, in this watch example, they're making 30 to 60-day loans at something like a 15% APR, right? So the interesting thing there is you're getting that higher yield because it's private debt. It's over collateralized because it's a luxury watch with a easily ascertainable value. And you don't even have to take on the illiquidity of 2 or 3 years on it, because that money comes back to you 60 days from now. So you'll start seeing that a lot of these types of niche use cases where you're able to provide private debt and somehow solve the liquidity issue as well, right? Like they'll all start taking off quite a bit. And then more and more complex assets obviously will follow that. But the easier the asset class is, easier to understand, easier to lend against, or easier to transact on the blockchain, those are the ones that are going to see a lot of traction initially.
So the increased liquidity then would drive down the interest or the APR, right? Or
It will
Theoretically.
over a period of time. You should see you should not have an arbitrage between what's happening in TradFi and what's happening
Right.
on the blockchain. Over a period of time, that arbitrage opportunity should go away. And even today, it's a little bit of it's perplexing to think that on U.S. Treasuries you're getting 5%, which is basically risk-free, right? Risk-free securities. But if you're borrowing against over-collateralized crypto on Compound or Aave, the APR, variable APR on that is a fraction of what you're getting on the US debt. And that should not be the case because although it's over-collateralized, although it's safe, and although Compound and Aave have not had any crises, presumably those assets are slightly more riskier than US government debt, right? So they should be, there should be a little bit of a premium there, but we're actually seeing that those assets right now you can borrow at a really low APR on those compared to, and in fact, like you could borrow at whatever 1% or whatever on your Bitcoin, and you can reinvest that in US Treasuries for 5%, right? So you should not have that arbitrage opportunity, right, in the future at least. So over time, I think these two, Web3 and Web2, are today like two different islands, and more bridges will appear over time, and you'll see that these ARB opportunities go away.
So you talked a little bit about like different instruments available and tokenizing them, putting them in a digital wrapper. What are some of like the biggest challenges today from that happening? Would you say it's mostly more on the regulatory side than the technical side, or what are your thoughts around that?
Yeah, I mean, it's certainly that I don't think it's a technical challenge at all, because between fungible tokens and non-fungible tokens, you can essentially tokenize or create a digital wrapper for presumably anything and everything. The challenge is really, regulatory in a big way. We don't even have stablecoin regulations, right? We need that as a foundation before we even talk about securities and what's a token, what's a security, and all of that other more complex stuff. If you look through all the case law for that went to the appellate courts on securities related arguments, you'll see there are examples of everything from, even though the Howey test itself, that happened 60, 70 years back, there's been, challenges about whether whiskey cases are securities, whether earthworm, literally there was a scheme where people were selling earthworms, saying that you can buy these earthworm beds from us because earthworms are going to be really valuable to use as tackle for fishing and stuff. And so once they reproduce and you have a lot more, like you can sell it and make a profit. And there were you can search and see there are court cases about whether the sale of those earthworms constitutes the sale of a security, right? So of course, right, like there's a lot of legal precedent on taking everyday objects but packaging them in a certain way that makes them an investment contract, the whole scheme an investment contract. But still, the individual thing itself, presumably is not you could not make the argument that earthworms are securities, right? They're not. But in the way they were packaged and sold, maybe the whole thing was an investment contract, and thus ask the question whether the buyers participated in an unregistered securities offering. Today, I think the regulators have taken the stance that all tokens are securities. And there's a lot of us who feel that that's really unfair because, like I said, you can take anything and you can put a digital wrapper on it. And, if I have, this novel in front of me and I say, I'm just going to create an NFT that represents my copy of this novel, and you can buy this NFT and it gives you a right to redeem that NFT for the physical book that I'll ship to you. Suddenly does that NFT become a security? No, it does not, right? Same thing with trading cards, right? People bought and sold trading cards all the time. And if I simply represent those trading cards with NFTs and say, now you can buy and sell these NFTs, should that suddenly become a security? Not if the trading cards themselves were not securities, right? So I do think, we need a lot more regulatory clarity, obviously, before you'll see a lot of other asset classes getting represented through tokenization.
So you've got a vast knowledge domain of like real world assets. So I'm going to ask a question that maybe is going to get me in trouble here, but are you guys looking at, like at Roofstock, are you guys looking at other real world assets aside from real estate and like, tokenizing them?
Not Roofstock per se, because we really specialize in the single family. I mean, even within real estate, it's such a narrow, it's a big enough asset class that, that takes we have mapped, every single family residence in the country. We know, what was the last sale value and and we have our data analytics and machine learning through which we're looking at what might be a predicted market rent for it. So we have very deep data on the sector. It's not just that we have brokerages and contacts that allow people to buy and sell these, but we actually track every property in the country. And, some of that data is updated weekly, some of it is updated monthly. At any point in time, we know, if properties are owned institutionally or by retail, who owns them, what was the last price it sold for, and all that kind of stuff, right? So that's taken, obviously that data and building all those analytics, that's where we've spent a lot of our time, and that's really our area of expertise. But, I am advising, when I find good projects that are trying to bring good use cases, RWA use cases to the blockchain, I do try to help out, whether as a formal advisor or just informally.
I think there is a future where like homes are going to be purchased in this manner, that Roofstock, and not necessarily in like for an investment purpose, just like, like for myself speaking, that, I just want to purchase a home to live in. I can't help but wonder, when I purchased my home and there was like a mortgage involved, so it required several steps. I had to take out, a mortgage, there had to be, a check on the deed. There was a lawyer involved because I live in New Jersey. Appraisal, home inspection, et cetera, et cetera, et cetera. So there were a lot of people involved in this process, and it wasn't just me and the seller. So maybe I'm sounding a little conspiracy theorist, but do you think that there's just like maybe some other interests involved that are kind of helping, that are preventing from this process from happening? Just because when I look at my own home purchasing process, there were just had maybe like a dozen different entities involved. And I think they all kind of have a vested interest and a hand in the cookie jar. Because if you think about, especially with the deed check, right? Like if it's tokenized, you don't really need, it's on the blockchain, right? So it's decentralized, it's immutable. So just kind of curious what your thoughts around that are.
Yeah, the dozen that you talk about are just the folks that you interacted with. If you look at your HUD statement, there's probably 40 others that you didn't know existed. But all, kidding apart, right? Can you, of course, if the title was on the blockchain and you could just do a search and see, there's no liens or encumbrances, that's, technologically, it's really easy to do, right? The complexity here is really that in the US, we have 3,500 counties or something like that. Each county has a slightly different process for how they do title recordation, and some of it is full, more or less automated. Some of it is still a lot paper-based, and you might actually have to go, flip through ledgers and stuff at the county office. So, it's not something, again, in the US, since we have the strong notion of what a federal government's role is and what state and local government roles are, it's, hard to go and say, oh, we're going to create federal legislation that says this is how we're going to store title and deed information, right? And now, if they were like city states like Singapore or the UAE, or it's a lot easier to accomplish those kinds of things in those models. But in our model, that's how our founding fathers thought about it, and that's fine. There is a process, and so I don't, in addition to the fact that we've come up, over the last 50, 60 years, whatever, we've come up with all these checks and balances and various intermediaries participating in these transactions. It's all because the underlying way in which title is recorded and all that, happens in a certain way. So, I'm not one for over time, I think these things will, slowly change, but there are people trying to tackle some of these problems, right? So for example, you can think about the DMV as another example where, the title to your car, is getting filed somewhere. If you've taken if you took a loan through Toyota Finance or Honda Finance, that's, obviously they're holding the pink slip until the loan is paid off. There's a lot of those processes that are also fairly manual. And in some states, there are companies that are now trying to automate the DMV registration process on the blockchain. So again, I think you'll start seeing a few of these as really proof of concepts first, right? For it to become something that's just like nationally, there's one database and you can see what's happening. I think that's probably a long ways off. But again, what's promising is that people are looking at both the simpler problems and the harder problems. Companies like Roofstock, we took on a hard problem just to see what was possible by legal engineering, combining it with what the technology already had to offer. Because in our case, we loved Ethereum for its composability. We didn't want to sit and build an NFT marketplace. There's several on Ethereum already. We didn't want to create our own lending marketplace. There's NFT lenders that do that already. We didn't want to create a mode of exchange through creating our own fungible token. Stablecoins were there for that. So we were able to take all these things that already existed from a tech perspective and just focus on the legal engineering that allowed all this to happen, right? So, but again, I'm at every conference, I'm amazed to see companies taking on simple problems all the way to more complex problems, including supply chain is one more area where, there's stuff that's traveling or parts are coming from different places around the world, getting assembled in some factory, then it's getting shipped out on a truck somewhere. And if you're able to essentially keep track, a good example would be airline industry, right? Like this thing that happened with Alaska Airlines, and then where the door flew off recently, right? And then Boeing started researching, and they were like, "Oh, these bolts were coming off," and then that led to who makes these bolts and what's their quality check, and that the FAA requires every part to be cataloged and documented, so you know exactly where something is coming from. But if it's on the blockchain, it's just it's right there, it's transparent. You know exactly when that part came off the plane, went back into the plane. So there's a lot of use cases where this technology is just perfectly it was a purpose built for something like this, right? So we should start seeing a lot more of those examples get implemented on the blockchain.
Yeah, and that's what really gets me excited and bullish about this space. I mean, I love like NFTs and, PFP projects and collecting, but I think that's just like a small part of the equation. Or, I mean, I don't know how you want to measure, but it's part of the equation, let's say. But there's just a whole bunch of different use cases where having that like decentralized, immutable data accessible can help out. Like, yeah, supply chain for sure is one of them, real world assets, which we talked about, and just so many different use cases and ways that you can tackle a whole bunch of different problems. So I'm really excited about that. And I see a lot of parallels between what happened like in the 90s with the internet and what tokenization can do today and in the future. So, I'll ask you one more question before we drop off. So people have been listening to this podcast. I'm sure that they're super excited about Roofstock and they're going to go look into it. What advice would you give to investors looking at like blockchain-based real estate investments?
I mean, so it's really, it's a very interesting time in the market, right? The real single family real estate, by the way, as an asset class, has been has performed remarkably well in the last 20 years, right? The first kind of real battle testing that took place was during the 2008 economic crisis. We saw home prices fall in several neighborhoods quite drastically, but still a lot of people, they needed a place to live. And so if they were living in big mansions, they, downgraded to starter homes, but they still needed a place to live. And so as long as these properties were generating rent throughout this economic crisis, of course, prices went down for a period of time, but then they rebounded from that within 4 years, and then went up astronomically in the last 10 years, right? So the asset class not only survived but thrived during that economic crisis. And then when you look at the more recent COVID crisis, in essence, a lot of people were vacating multifamily homes because they didn't want to sit in 600, 800 square foot apartments, and they wanted a little bit more space. They needed an extra bedroom. They needed a yard so they could walk around a little bit. So in fact, like we saw single family homes again really go up in value in an unprecedented way because there was a lot more mobility. People left their urban multifamily units to go to the suburbs or even work remotely from other cities. So again, the asset class has performed well. So as an alternative asset class that's not correlated to the stock market, produces some income on a regular basis, and then over a 10-year period, typically the value goes up as well, because when you look at demand supply characteristics, we have, I think nationally, the demand for single family housing exceeds supply by 5 to 7 million units right now, and we're just not able to build them fast enough, right? So as an asset class, again, it's not that somebody should put all their money into real estate, but you have a lot of your money in public equities, public debt, some of it in, a small portion that's allocated to alternative investments. Some of that can be in real estate. Some of it presumably should be in crypto as well, if you feel that, cryptocurrencies are a thing of the future. And now with Bitcoin ETFs and stuff, that's become a lot more accessible to people. You don't have to think about wallets and how to, remember seed phrases and things like that. So from that point of view, I mean, I think, everybody should look at some small allocation to real estate as a alternative, something that's not correlated. It's interest bearing, or yield bearing instrument. And then, it's also interesting right now because the Fed had to increase interest rates so rapidly in the last 1 year. Mortgage interest rates went up all the way close to 8%. They're now down to the high sixes or something, but it's still not very affordable for people to get these traditional loans to buy properties. But if you had a lot of Bitcoin sitting around, for example, and you could borrow against your Bitcoin on Aave for next to nothing, I mean, like, why wouldn't you want to, take some of that money and like, you don't have to sell your Bitcoin because, you expect it to go up over time. Just borrow against it, buy a house, right? And that you're, diversifying into a new asset class. And again, right, Bitcoin might be volatile. It might go up, it might go down, but having some of your money in these diversified asset classes is you go to any money manager, they're going to talk about diversification. So that just sounds like common sense to me.
I said one last question, but I think I'm going to ask another one that just kind of popped in my head.
Sure.
Do you see this kind of like displacing REITs, because they kind of fulfill that function too in terms of diversification, but they might not?
It's a really good question.
Yeah.
If you look at REITs, public REITs especially, I think I would now argue that today a public REIT is not as much about the underlying real estate. They're more like public corporations that hold a lot of real estate, in the sense that the price movement of the public REIT share prices are actually highly, highly correlated today with the S&P 500. If they're a good REIT, if they're a bad REIT, of course, it's not going to matter. But even the single family REITs like Invitation Homes or American Homes for Rent, if you go and look at their last 5 or 6 years charts, they might have outperformed. Some of them might have outperformed the S&P 500, but the graph looks really, really similar to what the S&P 500 graph looks like, right? So I would argue that public REITs today probably are not as diversified as you might have once thought of them to be. Sure, the underlying asset they invest in is in real estate, but they're now very correlated to the stock market. So from that perspective, having a diversified portfolio of rental assets that you own and manage gives you that true diversification.
Yeah, I totally see that. I can ask you like a million more questions, but I know we're over time. Sanjay, I appreciate you so much. Thank you for appearing on the pod. You've talked about a lot of different things in terms of like real world assets and how they can be tokenized. And yeah, there's just so much that, I'm so excited about in talking with you. So I think we learned a lot on this episode. So appreciate your time. And maybe we'll have you back on again and, sometime in the near future and give us some updates on how things are going with real world assets.
That sounds great. I had a lot of fun too. And thanks for having me. This was awesome.
And that was our conversation with Sanjay. I thought it was really profound in his thoughts about how we can apply digital wrappers around real world assets. And that's essentially being done today and will continue to be a trend. I also tend to agree, and it's something that I've talked about on the podcast, something that he talked about as well, which is this concept of what chain is being used. I think today people are fanatical and tribal about their chains, whether it's Ethereum, Bitcoin, Solana. Guys, and like Sanjay said, I just really don't see it in the future. I just don't see that being a thing. In fact, I would even go to argue that it's becoming less of a thing today than it was 2 years ago when I first started the podcast. And I think it's going to continue down that trajectory. I just don't see, if we're going to accept the argument that the blockchain will be ubiquitous everywhere in the future, which is something I think all of us would, accept as an argument. I just don't see a universe where you have everyone thinking about what chain like things are. It's kind of synonymous with people being worried about what programming language, their apps are being written in. And like I said, I just don't see, if we're going to talk about mass adoption, I just don't see like the choice of chain being a part of that conversation. So, all right. Hopefully you guys enjoyed that conversation as much as I did. Let's move on to Scoop 3, which is a next generation podcast player built using Web3 technology by Media 3 Labs, the parent company for the podcast. In fact, I would argue that there's some parallels between what we talked about with Sanjay and Scoop 3, which is this concept of media consumption. And media consumption, I think, my thesis is that it's going to be tokenized in a wrapper as well. So whether it's your podcasts, your TV shows, your movies, whatever media content you consume, that'll be memorialized on a digital ledger, aka the blockchain. And that can be used all sorts of different ways, which it's, one way could be to signal to others that you consume that content. Maybe you're looking for rewards or recognition, whatever. 100% confident, not 99%. Personally, I feel 100% confident on this, that your media consumption will absolutely live on the blockchain. And that's essentially what Scoop 3 is doing. I mean, we are starting with podcasts, and that's what Scoop 3 is, but the company, think of it this way: is Media 3 Labs, like Apple, like that's the company name. And then we have a product, and Apple has like, the iPhone, or they have their Macs. We have a product called Scoop 3, but we've got our eyes on other things as well. It's not going to be only Scoop 3. So all that's to say is that we are starting off with podcasts because that's the easiest technology to make a major impact in. It's a growing segment. It's almost like 30% annually compounded. So a lot of opportunity there. It's built on Web 1 technology. So it's almost like we can skip a generation, just go straight to Web 3. So anyways, if all this sounds Greek to you, I can go on forever. That's fine, because I will be hosting a webinar on February 1st to talk about it more in detail. And on this webinar, I'll be giving away a POAP for attending, which you will definitely want to collect, because if you have the POAP, then you will be eligible for a raffle that I'll have for drawing for a friendship bracelet by Alexi Andre. It's an Art Blocks piece, in case you don't know, or an Amazon gift card, because we will be having some normies on the call who, the concept of like Art Blocks is probably a little bit over their head, and that's fine. Just the thing is that you do have to attend to collect the POAP. So please register for the event. Link is in the show notes. So that's it, folks. So I'll be seeing some of you guys at the webinar later this week at the time of this recording. And for everyone else, until next time.
Welcome to the blockchain experience. Bringing dope content to the audience. Welcome to the blockchain experience. Bringing dope content to the audience. It's a blockchain spell made of David's got so much to tell. Bringing you the latest news without fail. Hey, decentralized and secure. It's been making waves. You can't temper with clutter. It's got the blockchain experience. It's a must. Hey, welcome to the blockchain experience. Bringing dope content to the audience. Welcome to the blockchain experience. Bringing dope content to the audience. It's not just for the big boys. It's for everyone. It's a new way of doing things. It's second to none. So jump on board. Join the revolution. It's a blockchain experience. It's a movement. Give it up, give it up, give it up, give it up, give it up for the blockchain experience. It's a game changer. It's a game changer. Welcome to the blockchain experience. Bringing dope content to the audience. Welcome to the blockchain experience. Bringing dope content to the audience. It's a blockchain experience. It's a blockchain experience. It's a blockchain experience. Give it up, give it up, give it up for Major David. Give it up, give it up, give it up for Major David. Give it up, give it up, give it up for Major David. Give it up, give it up, give it up for Major David. Welcome to the blockchain experience. Bringing dope content to the audience. Welcome to the blockchain experience. Bringing dope content to the audience. Welcome to the blockchain experience. Bringing dope content